if somebody comes to you, say, I'm gonna buy a house, so what's you gonna say?
Well, I think the long and short and the simple thing that I try to do when I talk to someone is, do they know their finances already? I mean, they know how much money they earn. They've been in a job for 2 years. They've got a 2-year residency someplace. There are just minimum standards of things that I'll ask people and just sort of get a feel for. Why did you decide to buy a house? What was the purpose? A lot of times people will say, I've been renting and I'm tired of throwing my money away. I mean, rents are high, exponentially higher than what it would be when you get a loan for a property that you can afford. Your rent would be a lot of times maybe 20-30% less.
So what do they need, or what you need from them to provide you to give them pre-approval or pre-qualification letter, if I'm correct?
Yeah.
So
what we typically do is a conditional pre-approval.
okay.
A pre-qualification. Those terms pre-qualification and pre-approval get used interchangeably, but they're different. Pre-qualification is just kind of somebody telling you a few things. You didn't pull credit. You have really no idea of what their situation is, and you kind of do some numbers and go, you could probably afford this, and then that is essentially a pre-qualification. We do a conditional pre-approval where the person actually is going to submit an application to me, or I'm going to do it on their behalf, and I'm going to know their credit score.
Okay.
I'm going to know what their monthly income is. I'm going to have a lot of details that when I choose a loan product based on their credit score, I'll be able to give them a 90% chance, idea of what they could qualify for. And in the world of lending, lenders will pre-approve you. We will pre-approve you for more than you might be able to afford. I mean, you could afford it based on what the front and back end of your DTI is, your housing expense, and then all the other expenses that you have put together. But just because I'm going to lend you the money is not a good reason to take it. This is like the maximum amount that you could afford. Now let's figure out, how do you want to live? How can you afford to do all that?
So you're gonna pull their credit to find out about the credit score.
Right.
You're gonna ask them about their income.
Yes.
And probably you need their social security number, right?
Definitely need social security number. It's a non-starter without it. I can't pull credit if I don't have a social security number. And in the world that we live in, I think people are sometimes they're a little bit suspicious, and rightfully so. I mean, there's all kinds of people out there trying to do criminal activity. So, but if I'm working with you and I need your social security number, that's private. I mean, nobody's going to have that information except me and my company. So, yeah,
so
it's
it's private, just between you and client. It's not going to publish anywhere.
No.
You're just using it certainly for.
We don't even sell the information.
Okay.
It's totally.
So there is a portal. The clients go there and put your information, or you ask him like over phone, or how that's gonna work?
There's really 3 ways to do it. 2 of them are on the phone, and I'm asking all the questions that I need to get the information, and I can enter it myself. I mean, I can go ahead and submit the application, and the borrower can just consent to the fact that we've done that, and it's all done digitally. The other way is that I send them my billveith.supremelendinglo.com, and they click on the link, and a lot of times I'll tell them, look, when you get to that point and you hit start, if you get stuck anywhere, just call me or text me, and I'll guide you through it. And if we do it right, that should take about 10 or 15 minutes. I mean, it's really not a long process to get that done.
A quick question: does it matter how much money they have on their account?
Well, it's good to have reserves.
Okay.
I'm not. Here's the thing: I will always ask about checking and savings. I'll ask about 401k, any pensions, anything that would qualify as an asset, or if there's going to be potential gift funds. All those things kind of fall into a category of how much information I'm going to have, and how are they going to be able to qualify? I mean, because if you don't have any money, that's what down payment assistance programs are for. But it's a good idea to have some idea of your finances, so you can, so everybody's going to get a good feel for how this is going to work. Because I mean, it's a lot of work to go and do this just to tell somebody, no, you can't.
So my understanding is you get some basic information from the client and just choose which product fits better based on their financial situation.
Exactly.
It might be first FHA, first home buyer loan, or it might be something else. You know all that, and you choose them. Okay, that program, that product fits much better, and you can get a better rate, better closing cost, and all that, right?
It's driven by the credit score a lot. I mean, because, for example, with a conventional loan, I mean, there are guidelines for all of these loans, but there are also overlays for us as a lender. For example, with a conventional loan, depending on the lender, you could find somebody that will do a conventional loan for a 640, 660 credit score. We don't. I mean, I can run it all day long, but if you don't have a 680 credit score through Supreme, it's not going to happen. I mean, manual underwrites can happen, and we can do some things, but typically desktop underwriting doesn't like any conventional loan product under 680 with us. So we're pretty conservative.
So what are the different type of the loans? You mentioned conventional, so we know there are different, like conventional, FHA.
Right. There
are different down payment.
Exactly.
Amount, so.
A conventional loan is typically 3% down. It's it's for a primary purchase. It's essentially for 1 to 4 units, but at 3% down, in other words, 90% loan, 97% loan to value. That's a minimum. But the more you put down, for example, up on a conventional loan, if you put down 20%, you'll avoid mortgage insurance. It's just another layer in the payment process that adds on what your principal, interest, and taxes and insurance are going to be on a monthly basis. So FHA, that typically is a 580 credit score with us. VA is a 580 credit score. Even the USDA loans that we do, that's a 600 credit score. But the VA and the USDA loans are 100% financing. In fact,
yes,
it's a good route to, if you're VA and you haven't ever used your certificate of eligibility, you're a prime first-time home buyer thing to get a really good deal. There are costs involved, obviously, but down payment is not one of them. And you can get the down payment assistance if necessary for the closing costs and everything that go into the loan.